that company flopped. I mean, we had a good run for a little bit, but then, there was an investment in infrastructure that we just didn't want to do. And because our customer was not the customer we were looking, we didn't see really where this was going to continue to go. So we decided, well, look, let's take our losses and, go our separate ways with my partner.
Okay, we have Gunnar on the show. Gunnar, thank you. Gunnar, thanks for coming on.
Thank you. Thank you for having me, Robbie.
Yeah, we were just catching up. Prior to us starting, you were telling me about being in Toronto. You're currently in the West End right now in Brampton.
No, I live in New York City right now.
You're in New York.
But
Okay,
yeah, New York City. I'm actually outside New York, but yes, I've been in New York City since 2008 now, so quite some time.
gotcha. But you did live in Toronto for a bit.
Yes, yes. 1999, I was in Toronto, and I was doing this program with the University of Toronto, and I was also going because at that time you might remember, maybe you're too young for that, that there was the 13th grade, right? So if you wanted to go to
Mm,
university, you had to do the 13th grade. So in my case, I had to finish high school as well as try to get my university studies started. So I lived in Brampton, and I was going to North Park Secondary High School in Brampton. So that's how I know the area. We were talking about Toronto and the area of Toronto. So, I'm more familiar with Toronto, the city, and the surrounding Brampton, Mississauga areas. Yeah.
yeah. So I mean, the West End, definitely.
Yes, yes, yeah.
Cool. So I mean, we got connected because you're part of a few entrepreneurial networks, and you're currently working on Carl, right? A
Correct.
fintech play, right, for the
Correct.
investment world.
Correct.
Yeah.
Yes,
So
yes.
yeah. So tell me a little more about Carl, and we'll jump right into that.
Right. So Carl is a hedge fund platform. We specialize in quant hedge funds.
Yeah.
So quant hedge funds, the way we define them are generally going to be investment programs that are designed in a way that follow very specific rules and require very little in terms of human intervention. So when you think about, investment professionals, or maybe a hedge fund manager, most people might think about a guy who is sitting in front of the computer or sitting with a group of people making decisions about how to allocate capital. In this case, all those decisions, all that, process of going from, I believe this could be a good idea, or where is the information, how could I analyze the information, and go from that process of making the analysis to actually creating, having a position in the market. All of these decisions are made by a computer program. So this is what we call investment algorithms, or computer programs that are designed to ingest data, analyze the data, come up with a decision, which is whether to buy something, sell something, or maybe not do anything. And that's the strategy, right? So around that, it's an investment strategy. We partner directly with quantitative hedge fund managers, and we make their investment strategies available through our mobile app. So our mobile app is it's for direct to consumers, so it's a B2C opportunity. What investors get access, they get access to managers that otherwise, or investment strategies that otherwise they would not be able to access. If you wanted to invest in a hedge fund, the typical minimum is going to be half a million to $1 million. Through the process that we have put together, we are able to provide you with this access for a lower minimum. Our minimum to become an investor is $20,000, but this gives you access to all the managers within our platform. And we're really trying to disrupt the way that the industry works, as well as to creating a much bigger, industry for the hedge fund industry, right? So some of the things that we have brought with our mobile application are things that, you probably expect from any mobile application, from any services that you probably use, especially after COVID, digital, always on demand type of service. The way that you invest today in a hedge fund company, you have to do your own research, especially if you're a self-directed investor. You have to do your own research. Uh, Once you have done your research, which is very difficult because there is not a lot of information about these entities. Once you have found a fund that you actually like or you want to invest with, you have to have the minimum, $500,000 to $1 million to invest. Once they have, allow you to invest, you will receive once a month, maybe once a quarter, it depends on the company, a statement on your capital. So, you can think about that and you're like, what? You're telling me that I only know how my money is doing once a month or maybe once every 3 months, and that I have to come up with like this huge amount of money to become an investor, and I don't have information about these companies anywhere. So, we believe that if we give you the information, we give you the right tools, and we give you the access, you will be able to make very good investment decisions. So with us, you know, we do due diligence on all the funds. So we do the process of doing the analysis and finding these firms, and then bringing them to you and telling you, hey, Ravi, this firm or these 10 firms that we have here, these strategies, we believe are good, and you should at least, take a look. Number two is the $20,000 investment minimum with us gives you access to all the strategies we have, and it gives you all the information, what they trade, how often they trade, what's their average return, what's their risk, who are the managers, where they've been, what they've done, videos explaining how the strategy works. These things you're not going to find anywhere. Number three is that we give you the tools to create a portfolio. And with this portfolio, you can see how this portfolio of hedge fund investment strategies would have performed over the last 6 months, over the last month, over the last year, over the last 5 years. This you're not going to find anywhere. Maybe, you have to be somebody working within the industry that has tools for institutional investors, maybe a Bloomberg terminal, something like that. Then the next thing is that once you're comfortable with that portfolio that you have built, with the strategies that you're invested in, you can follow your money in real time. You open the app and oh, okay, today I'm making 10%. Fantastic.
Mm.
You don't have to wait until the end of the month. Immediately. And we don't have any lockup periods, which is very common in the industry, or, any gates or anything like that. So we're trying to really give you access to, best in the industry tools, best in the industry funds, so you can diversify. You have your stocks, you have your 401k, you might have, your insurance, and now, you can put, a little bit of your wallet into quant hedge funds, and hopefully, what we want to do is really help people reach their financial goals. Some of these vehicles, people have a lot of opinions about hedge funds, but once you really get to know them, get to know the strategies, get to know the objectives, because this is the other thing, right? A lot of these strategies have a very particular objective. Like, a strategy will only make money when the market drops, right? So if you're like, okay, well, I'm thinking about retiring in the next 2 years, and I don't want my 401k to take a hit if 401k,
Hmm.
it's the retirement account in the US, but
Yeah.
your retirement account to take a big hit, what you would do is you can invest, kind of like buying insurance, right, into one of these strategies to protect your overall portfolio. So you don't have to be at the mercy of what happens to the overall market, right?
Hmm.
Or if you want to just decrease the volatility of your portfolio, let's say you like to invest in a lot of tech companies, or highly volatile growing companies, but you want to get your overall volatility a little to be less. So here's where you'll find very specific instruments to do things like that. Now, if you just want to do, 20% in an annualized basis over the next 5 years, that's also a thing you can find. So we give you more control. more certainty about what you might expect it might happen with your capital, and we give you, the tools and the information that you're not going to find anywhere else.
Mm. So you gave us a lot to digest here, right? I want to
Yeah,
break this down into pieces and
let's
kind
do
of
it.
go through it, right? So the quantitative finance. Let's dive into that first, right? So as I understand it, high frequency trading came to be in about 2008, 2009. It started picking up, and trading became like a human endeavor to now a computer endeavor, where you can make these multiple trades really quickly and make margins off of fractional trades. And what ended up happening was people realized if they can bring down the and the latency between connecting to the stock exchange by being physically close to it, or even better, running like fiber optic cables right to the center, right? Like I think there was a firm that was like legendary for spending millions on on getting a fiber optic cable that they laid to even have a better connection to the New York Stock Exchange. And other companies have built bought buildings right next to the stock exchange trying to get access to this, and there was a whole run in this industry to get quantitative finance set up and the infrastructure around it, and it really brought developed this brought like I guess like these computer science and these high technology minded individuals into the finance industry. And from there, kickstarted like the fintech revolution, right? Okay, how can we use the technologies available in software? Like Mark Anderson said, software is eating the world. How can it eat into the financial industry? How can we, slice away parts of the finance that are traditionally run by these really hierarchy industries that's heavily regulated, and use the power of software to kind of like democratize it and give it the hands of more people.
Right. Yeah, I think the quant that I mean the industry you're describing, the finance, in general, it's very, very dependent on software. I mean, we've been developing software for the market for quite some time, and I think it's a process. Now, obviously, high frequency trading, in my personal view, is a very profitable business, but it has over the years become very, very difficult to
Yeah.
participate. So only really big firms can allow themselves to have the investment that is required to continue participating in that type of
Hmm.
business structure. From the quant hedge funds that we have and the quant funds we offer, right? It's like you say, is the next step. Once, computers took over what basically brokers were doing and market makers were doing, now we have all this technology to reach the market very quickly, execute trades in, a nanosecond. What started to happen, and I think this is, I started working in high frequency trading actually in 2009, right
Hmm.
after school. And, what I saw, I mean, part of Carl and part of, I guess, is myself. It's a progression of my career as well as a progression of where I see the technology going. Is that first in, early 2010, we started using more and more alternative data, and that's where like there was more and more data was becoming available. And before that, most quant managers were fighting each other, mostly using price data or market data. Once this other source of data became available, then basically opened this whole other world, right? Like credit card data, cell phone data, traffic data, website traffic data. There's all these other sources of data. It's so much that there is no way one single person can really analyze this data. And because the data is becoming to be more abundant, so and it's coming in with greater frequency, you know, we believe that only, you know, computers will be able to crunch this data and come up with an answer. Now, I'm originally from Chile, and they have a saying over there that with enough time, everybody's a genius. So yes, we can give this data to somebody who might analyze and will reach probably the same conclusion as as a manager that has a bunch of computer infrastructure. But because time is money, we prefer to invest with the guy that has a bunch of computers to analyze this data and come out with a conclusion faster.
Cool. So quantitative trading, right? Like let's talk a little about the quantitative the hedge funds that you operate on and you work with. Um, you give us a kind of a head level overview, right, of how that kind of operates, but how does that actually work? How do they execute trades? What makes a quantitative hedge fund different from a regular hedge fund? Right? They use computers and algorithms, but exactly what are they doing?
Right, right. So, they all going to have a few different aspects, whether it's, their objective, right, or what they call the mandate. So whether their mandate is to, for example, just hedge a portfolio, whether is to, be a long only, meaning they only buy, they don't short, and be equity only. But, the process generally looks about the same for most of them. It's that there'll be some sort of idea, right? Like that, light bulb moment, that you're like, okay, I believe that, if I just to give an example, if I can get my hands on cell phone data to know how many cell phones are at a Walmart or a Home Depot at any given moment, plus the market data that is coming in, I can come up with a model that tells me the pricing of the stock right now. That will be more accurate than if I didn't have the cell phone data. Okay? So that's the idea. Now, we got to put all the data together, create a model, an algorithm that can analyze this data and provide us with that's basically the research part, provide us with an statistical analysis of this idea, right? Now, once we test that idea, and there's a lot of different ways to test it, we see if this idea could generate a return, right?
Mm-hmm.
If we believe this idea can generate a return, and it's okay, and we are okay with the risk, then this set of rules, meaning we have market data, we have cell phone data coming in, it goes into computer, it scrambles all of that, analyzes, and then says, buy at this price, for example, buy Home Depot at $25. So, all of that process from the idea to the research to the decision making, has been automated. So now that process can repeat every second, every minute, every hour, every day, until we decide, okay, now we have, for example, credit card data. So I think that I can make my system or my strategy better by adding credit card data to this. So generally the process is to be able to use a lot of data, try to understand the data, and create a process that can analyze the data and give you a decision. Now that decision goes straight to the market, like you said, and it gets, executed. Now, at that point, you have a position in the market, and you're gonna have to, at that point, initiate something like an order management system or some sort of risk management system that is it's going to either hedge the position, is going to exit the position given some rules, or is going to, probably not do anything. So those are generally, but the way that I would say that it's easy to maybe and shorter is that it has very low human interaction from, there is some what they call, semi-quant managers. They'll have a process for the research. The research says you should buy this, 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 and this, and then the manager looks at that, looks at his worldview, and says, well, I'm just going to buy the first two, or I'm going to buy the first three. And he's making a decision on, that it's not what the process would have otherwise done, right? So now there is no way to test whether it's the manager that has that is really good at choosing these stocks other than seeing if he's making or losing money, or knowing if it's the process, right?
Hmm.
So when we have a process like this that we can repeat and repeat many times, we can easily tell whether the algorithm and the process, it's working and hopefully will work in the future.
I mean, that's really interesting. What what goes into making these algorithms, and how elaborate or intelligent are they? Are they simple like if statements, like if this happens and do they if this happens this happens, or is it like a pattern recognition, like deep learning, like that's going through and learning the systems? Like how elaborate are the systems?
It could be very simple, as like you said, so like some if statements that it's following certain data coming in, and based on that data, it triggers a signal, and up to artificial intelligence, machine learning processes with that are consuming terabytes of data every day to manage a portfolio. So there are simple, very elegant process, and there is some elegant but not so simple, very complex processes. Now, some people argue that if the process is simple, then somebody else is going to be able to put it together sooner or later. Probably sooner than later. While if the process is very complex and highly technically difficult to put together, then it's going to take a lot more time to imitate and have a similar process. The people that are behind this, generally, there's going to be somebody who generally is going to be very seasoned in finance, whether it has worked at different firms or different hedge funds. But behind there might be a team or a group of people where there's going to be computer scientists. It's very common to find people with PhDs in math or PhDs in physics that are working together, in collaboration to come up with this type of algorithms and this type of investments. Yeah.
Hmm. So, like I want to talk about that word you use, which is worldview, right? Like if the manager decides that this fits his worldview or not, you know, does that worldview idea come from years of experience, understanding? Is it guttural instinct? The human. I'm interested in the human and machine intelligence is mixing, right? At what point, do you feel it's better for a human to step in versus let the machine make a decision?
That's a very good question. So at Carl, we look for strategies that have very, very low human interaction. And yes, human interaction is important because there's certain asymmetric risks that you're never going to be able to get rid of, right? For example, you were talking about, these companies connecting through fiber optics and this. So what would happen if you lose all your market data? Then your computer cannot run on its own, and we might want somebody with a finger on the switch to like say, well, we stop trading or we sell out or do something like that. But in general, what we like about quant strategies is that they follow a very scientific methodology to come up with a solution to the problem they're trying to solve. So it's more about what, let's say, the science or the numbers say rather what the manager thinks. And I think that there's also a lot to say about time frames. The shorter the time frame, the more reliance you're going to have in a computer. This meaning, like, if you're making a decision, you know, every day about what you're going to buy or what you're going to sell, you know, 24 hours might seem like a long time, but if you have a lot of pieces of information, a computer might be better suited for a job like that. Now, if you go less than 24 hours, 12 hours, 6 hours, if you're buying and selling every hour, you're basically, by that point, you're becoming a market maker maybe. But now, managers, there's examples of great, money managers, but generally their worldview is more like, you know, okay, I think, we think the vaccine is rolling out, the economy is going to open, the economy is going to do well, and things are going to be much better for everybody. So I feel less, you know, um, anxious about what the prospects for my job are going to be. So therefore, my worldview is that we should invest, right? We should. I think the market's going to do well, the economy is going to do well, so we should probably invest.
Yeah.
But that's you know there are managers that can do that and choose the companies that are going to be the winners over the next 3 months, over the next 2 months, and they're doing that very often. And they manage great amounts of money. So I think that there is a space for everybody. I'm not saying that quant managers over anybody else. I think that over the spectrum, uh, it provides you with that diversification between one and the other, right? I think it's like a conversation that you can have about like, well, at what point you get rid of the driver if the car can drive itself, right? So, there's always going to be situations in which probably you're not comfortable with the car driving itself, but other situations where you're like, yes, I think that actually my car parks better than I do. So,
Hmm.
I think that in that sense, technology has not gotten to a point where, we can discount the intrinsic decision making that some discretionary managers have, and some of them are very good at that.
Yeah, I mean, it goes back to our concern about machines running our economy, right? More and more markets being taken over by
Right.
machines. I think back in 2011, there was something. 2010, there was a flash crash, where like 7% of the global economy was just completely gobbled up in in a few seconds. And initially, it was written off as a computer error from these high frequency trading. But one guy was charged with it. Out of a high frequency trader out of a little shop in London. There's a great Netflix documentary about him, and he triggered it. His trades triggered this flash crash, and he profited X amount, like a few tens of millions, off that. But the world economy lost like billions of dollars, and it had to recover. And it kind of brought up this kind of a spiel of like, okay, when computers run more and more of our systems, who's over watching over the machines, right? And what's
Right.
how's everything kind of fluctuating back, when everything's kind of coordinating amongst itself. I think one of the interesting things about the financial industry is like it's like the hub of like almost like the collective consciousness of humanity. Like I did my undergrad in neuroscience and psychology at UFT, but I took a lot of like political science courses, and I took a lot of like economics courses. And one of the ideas like I really stuck with me, the idea that economics or like the market is really like the collective intelligence of society kind of working, like, or at least part of it. Some people view it as that being that being the actual like group mind, where other people see it as a part of the greater group mind. But essentially, the markets are basically like as billions of people's wants and needs being fulfilled, right? Through the companies, and the companies that perform those actions, and then people speculate on top of those companies, right? Right? Do you accept this worldview at all? Do you ever think about it?
Uh, it's hard to think like that. For me, I guess the way I see the stock market, right, and the market in general, it's a place where people transact and participate. If you're referring specifically to the stock market, right, most of I would say that yes, from the economic perspective, it makes sense. Companies buy a product. Consumers buy a product that somebody manufactures, therefore they're going to have more demand, their stock should go up, and this and that. But, a lot of times, if you see the numbers, the ones that benefit the most are a small number of people that are the ones that actually own stock, right?
Mm.
So, for example, there was a great article last weekend, and I don't remember if it was the Wall Street Journal or Forbes, but it's about the growth of ETFs and index investing. And basically, the article sees that it's becoming common ownership because everybody is investing through ETFs, and the owners of the ETFs, or the ETF companies, State Street and other, the big three, uh, are the ones that basically are buying through the ownership of the ETFs in these companies. So, I think that the market, I don't think the market is totally efficient, but in our sense and in our objective with Carl is that we want strategies like the ones we offer to reach more people. The same as the stock market, and there's companies that have done great jobs at that, making stock trading or investing more available, right? I mean, we are trying to do the same with a product that is outside, the stock market, right? It's a product that generally, hedge funds, quant or not, has has been a product that for as long as I can think of or as know of, it's been a product that has been for institutional investors only or exclusively, right? I mean, there's very few, and they're all very high net worth individuals that can participate in this, right? And if you think about that, it's like these are sophisticated, very large investors that manage large sums of money are participating in this, but most people are not able to participate or get access. So our goal is to provide access and say, look, there is an alternative. You can also participate as an institution does, and we're basically, leveling the playing field. Maybe you don't like hedge funds, which is fine, but at least you know that you have the chance to participate and to now invest the same way that an institutional investor is doing it. So I think for us is inclusion, financial inclusion. Here is an opportunity, get better diversification, and hopefully we will help you achieve your financial goals in a way that is probably simpler and more rewarding.
Yeah, that's a very, I think, much more simplified version of thinking about the markets and looking at things. Because the way I was kind of, I started looking at it from a different point of view. It's like it's more of this group mind where like, when millions of people are like transacting, you gotta get like this group consciousness coming up, right? And what I think is cool about when you inject software and technology into this piece is that you can map things out in greater context and greater detail. What's happening, right? Do you feel like especially being in the industry now that things have been computerized and you can see patterns better? Do you feel like you're getting a greater glimpse in how the world works or how the markets work through technology, through a lens of technology?
I think it's becoming more and more fragmented,
Okay.
which is creating a lot more data gaps.
Mm.
You know, it's it's a world where there is a lot of more fragmentation, which is not a bad thing, necessarily. And because of this fragmentation, more people can access, but that's creating, kind of, different sources of information. And the patterns that you might be talking about, these are less noticeable because there is a lot of fragmentation. Talking about, high frequency traders, that's how, dark pools started. Regulation has to follow to accommodate large players in the market that want to transact really big, chunks. Companies that offer free commission free trading, change the world for the retail investor, and created a whole different business model in which they can operate. So I think the market, yes, it's a collective. It's like a voting mechanism, right? It's
Mm.
people are, at the end of the day, we follow what kind of what people think and say, and that's the way people are voting, and we see it in the market.
Yeah, absolutely. The voting side, I've heard of that before. Like the idea people vote with their money, vote like by pulling in or out. You're kind of getting a speculation, like a prediction algorithm, right? That being set. In crypto and a few of the marketplaces, people have been trying to replicate this, like in a micro environment where you can speculate on almost anything, on the weather to like things like there's an idea that if enough people are like putting predictions on things, the average of it is generally really good. The idea of collective intelligence comes into play. How on the average of a large data set that things are pretty accurate in a certain degree. And I find that really fascinating, right? The idea that this group mind, this idea that collectively we're more intelligent than the individual. But going back into machines and Carl, like as a startup, there's always a hurdle in being in entrepreneurship, right? And it definitely helps to have sometimes run in your history. Um, is this your first time being an entrepreneur? Can you talk about your entrepreneurial record?
Right. Yes, entrepreneurship is definitely can be very rewarding, but it's hard. It's tough. It's very tough to be a founder. People talk about founderhood and things like that. But so after I was in Canada, as I mentioned, I couldn't deal with the winter. I went to Chile in the year
Is
2000,
is that
basically.
where you're from?
I was born in Chile, yes.
Mm, okay.
So I started a company. Well, it was everything very organic, I would say at that time. I was very young, and somebody, I learned computer science, and I was good at math. And in Canada, I took computer science classes while I was in school. I went to Chile. Chile was getting broadband internet, so it was, I would say, 18 months behind, North America in terms of like the explosion, right?
Mm,
The tech boom. And so there was a lot of needs for websites. And randomly, somebody asked me if I could help them with that. And I said, yeah, I can do that, obviously. And he referred me to somebody else after I built his website. So, and there was such a big demand that I started, with some guys from university, and we were building websites initially. And then, that turned into a business it called Optical Web, and that basically we became a domain services, website, this, provider. Back on those days, it was very different than it is today.
hmm.
And the business really turned into data management. So if you remember, storage on those days was very expensive. If you had a computer with, a couple of gigs of memory, it was an expensive computer.
Yeah,
It
yeah.
was very expensive to have memory back in the day. Like, pictures, forget it, right? So we basically, as the business evolved, we would build a website for you. And back on those days, there was an agreement we would maintain that website for you. So that was the revenue. We would generate more revenue, and depending on how much space or storage you would need, we would like, put a contract for you. And the more and more the business progressed, we became more of a data broker, if anything. So we were basically renting server space from other companies to be able to store more data. The company was a decent success. I mean, we at the largest time we grew to 120 employees, something around that number. It was basically an accelerated MBA for me, or I learned about business so much, the things that I should have done, the things that I didn't do. I learned about cap tables and all of these different things, and things that I probably should have done very, very, very differently. But it was a great experience. Company got acquired in 2005. I basically moved to the States. My parents were living here. I was trying to figure out what I was gonna do. I spent some time snowboarding, trying to find myself after the company was sold. And my dad introduced me to Bernard Smith, who won the Nobel Prize in economics for something related to game theory. I was very
Mm.
interested in that. So he said, well, why don't you come take some classes if you like this? And I took some classes that turned into me getting a master's in mathematics and a bachelor in engineering. At that time, it was 2007, 8. We were seeing a lot of problems. E-commerce was booming. I mean, it was growing, but we saw a lot of things. We thought there was an opportunity, and this comes to like more of like we think there is an opportunity, and maybe we didn't do all the research we should have done at the time. But the opportunity was that it's very simple, and you see it still today, especially in all websites probably owned by the government, that it says do not press the back button, otherwise you might get charged twice, right? Very simple thing, and we're like,
Mm.
we can solve that problem, and we did. We came out with all this technology, all of this to solve the problem, and we put it together. And then we started offering, we should have done it first as a transaction service, so charge per transaction instead of, we offer the service as, a monthly payment. And we realized that, companies were not so interested in this, because if they got the customer charged twice, it was not really their problem. So, there was some fees and that. So we discovered that the ones that were using our services the most were online gambling sites,
Mm.
because they wanted to make sure that that money got to them as quick as possible, right? Because it was mainly a latency issue. So it was that company flop. I mean, we had a good run for a little bit, but then, there was an investment in infrastructure that we just didn't want to do. And because our customer was not the customer we were looking, we didn't see really where this was going to continue to go. So we decided, well, look, let's take our losses and, go our separate ways with my partner at the time. That basically took me to New York, where I explained, look, I created this system to reduce latency and allow people to transact faster. And that's how I discovered market making, high frequency trading. So I came to New York and um, I started building for a company. I started building market making systems, order routing systems, actually, which is just a small piece of the entire thing. I was building
When
order
was
routing
this?
systems.
What period?
2009.
2009. Wow. Okay.
2009. Yeah. So, and then I started, let's say, that my career in the space of quant finance. Uh, from that, I progressed to building statistical arbitrage systems based on. I used to use a lot of what is called stochastic calculus to build models, and these models will become more like statistical arbitrage systems. Then I started dabbling in alternative data. I progressed from that to being part of a team that was in charge of a P&L, or a book of business. From that, I went to basically be a portfolio manager at a different firm, where I was basically in charge of putting together strategies to trade. As I was doing that, I was getting more and more interested in alternative data, but also I saw the difference between what it can be done, as I mentioned, right? So I had my first company. I didn't know anything about finance, so I went to hire well managers, right? Like anybody will do, so. Um, and foolishly, I would, expect that that money was going to last for a lot longer. And I would ask them to try harder, right? But, because of the way that the industry works for them, the fiduciary responsibilities and all of that, this, they, their returns were nothing great. And I was working within, on the other side, and seeing how some of these firms were, you know, killing it. So, you know, it was night and day. So that led me to like, how can I invest in hedge funds? How can I access more hedge fund investments? Because a 60-40 portfolio is not really for me. It might be for somebody else. You should have a 60-40 portfolio, sure, or 70-30, whatever you're comfortable with. But if you can make 20-25% in an annualized basis, that's the goal, and that's the goal we're trying to achieve with Carl. Is that that's a great portfolio, especially if the volatility is low. We found at that time, many firms that could do that. The smaller firms, that not a lot of people know. If you're within the hedge fund industry, you probably heard of many of those, but outside the industry, nobody knows them, right? Even when people say Renaissance technologies, right? Renaissance technologies gold standard in the quant hedge fund world. Very few people know of that firm, but they've done 79%, I think, on average for the last 39 years. I mean, they're
Hmm.
killing it.
Wow.
So we found many firms that fit the criteria that kind of I wanted, and this is something that we were looking at that point with my business partner, my current business partner, and but we just didn't have the money. We needed $1 million. We needed, half a million or more just to kind of for them to take our money. So we thought, look, there has to be a way for this to work, to make it work, and for more people to benefit. You know, I should benefit, my mother should benefit, you should be able to benefit, my neighbor should be able to benefit if they choose to participate. And that's how kind of like we started with this. If we get the information, if we get the data, if we build the connectivity, because we had to build a lot of technology from scratch to be able to do this, and be able to manage the complexity of the legal system and the compliance and the back end and the administration of these vehicles, we might be able to do this. And that's how basically we got started. Now, Cy Smith is my business partner. So he has been an entrepreneur all his life. No flops in his case. He first started a company that was acquired by AT&T. This is in the 80s. In the 90s, he started AirSage, which is a company that is still around, and that he was also the founder. So between the two of us, we've seen the up and down of being an entrepreneur, being a founder, and I think that at this point of our lives, you at least mentally prepare you for you know what's going to happen, what may happen, and what things you're going to have to deal with. And it's not easy, being a founder, being an entrepreneurial activities, definitely not the easiest route, I would say. But that's what we choose to do in our case.
Hmm. I love this. Quite the journey, man. I really vibe with that. Like, I've spoken to a lot of entrepreneurs, and I've spoken to a lot of like serial entrepreneurs, and but I think your journey is very transformational because you start off in different industries and kind of built around, built yourself up to where you are now. Do you find, like, looking back the past 10 years, or your of this growth, where you are now versus thing, like, do you feel like that was calculated, like you saw the growth of this and you went there, or did you just, like, opportunity kind of brought you here, like you saw the opportunity that they rose?
Yeah, I think that the first time around, it was like kind of like I fell into it, and then you see the opportunity, and then your brain starts thinking, and you're like, okay, I can do all of these things. I'm not gonna do it by myself. I need more people. I need this, and it goes. Then, the second one, I learned a lot at the flop that probably we saw the opportunity, we knew the problem we were solving, but we didn't really understand the problem from the customer side. And we designed a solution probably not for the right audience at that time. And we solved a problem for a customer we didn't know we had, and that it turned out to be not what we were looking to do from the get-go. But business always evolves and change. Now in this one, I think it came to be it came to be something that we saw the opportunity, we studied the market, and we put together a plan that goes with today's world. So what we saw as an opportunity, we saw all these firms that have been growing. You can name Betterment, you can name Wealthfront, right? That started in 2010, 2011, maybe. That basically, by using digital distribution to put something that Fidelity was doing before in front of the investors, we're able to grow a lot faster. So when we saw there was a change in the law, basically hedge funds were not allowed to do public solicitation until 2017, I believe. Once that changed, we already knew, look, if we're not going to do it, somebody else is going to do it. And that, the digital advertisement, digital marketing, and the distribution through the internet, is the way to go. So we saw that no one is offering this niche market, what we offer, which is quant hedge funds, right? And we also saw the opportunity because we know how to build technology at scale and take it at scale. So that's kind of where the insight came. And from us came from one, technology, and also from knowing the industry and seeing, okay, we understand the industry, we have some connections within the industry, we know what is possible, and if we can accomplish all these things, put them together, then it's hopefully a matter of time until people start realizing that in the best way to describe it is that people will realize that before us they had a hedge fund problem, if that's a thing that and we are the solution. So if you want to invest in a hedge fund, in a quant fund, and you are a doctor making $300,000-$400,000 a year, if you work in technology in San Francisco, and you're an engineer making $500,000, you don't have the money to go directly to these firms. But with our solution, you are able to get started with something that is very comfortable for most of our investors, 20,000. Now you have access. Before, if you look for them, you didn't find what you want, and you maybe put it on Bitcoin or something else, right? I mean, or you put it more into your retirement account. We launched 3 months ago, and we spend very little on marketing and advertisement, and it's very incredible to see the people that are coming. Most of these people are coming through organic search. So there is somebody, obviously COVID is providing people with a lot of screen time, but they're sitting around there. Maybe they just got their stimulus check, probably. But, they're sitting around and they're like, okay, how can I invest this money? What can I do with this money? Maybe I just sold a house. Maybe, I just cashed in on Bitcoin. Maybe I bought some calls on GME, and like suddenly I have another 100,000 in my pocket. And they're coming and they're like probably looking. And I think one of the values that we have is that we're on demand, always there. So they can download the app and make the decision whether they want to start an account or not. And all the information is there, right? So we see, and we're trying to more and more develop the product and our message, because these people are coming without us like knocking on the door and saying, hey, there is this here. They're coming because they're looking for it, which tell us there is a real market need.
Yeah. So I love this so much because it's democratizing access. The financial markets. One of the crazy things is the idea of accredited investors was meant to protect retail investors, by differentiating services, but it created a team that got all these advanced services, right? The 1%, if you're part of the 1%, you're, I recently learned about this. The 1% that we all talk about is anyone who makes more than $400,000 USD in annual recurring revenue, or $3 million in net asset value, right? Which is not a lot to be considered to become part of the 1%. And yet, if you're part of this class, if you're part of the accredited investor class, you have access to financial instruments that can give you almost 0% income tax you pay if you're a professional investor, and also can make some amazing returns. Everything from VC firms to quantitative funds that make double-digit kind of returns that other people are not able to get. Right? For everyone who are not in this class, the only time you see a double-digit interest rates is your credit cards. 14%, 19%, 25% credit cards, right? Right. But your investments might be making 0.25 in a savings account, 2%, 4% in a GIC, or some bond somewhere, or right.
Right.
right?
In the U.S., to be an accredited investor, it's you have to make more than 200,000 or more than 300 if you're married, or have more than $1 million in investable assets. And that in the it would be much more than 1%. It will encompass like a lot of people. But even if even if you are an accredited investor, right? Saying like, okay, you're considered an accredited investor, technically you do have access to these things, but generally the access has been restricted, just like you're saying. If you're part of that 1% or that small section, you have access to VC types, PE investments, off market types investments so yeah. And it's one of the reasons that it was supposed to protect, like you say. But I think what it has created is that it has created two tiers of investors, right? The one that can benefit more, and the one that basically doesn't benefit until somebody changes the regulation, or there's services that appear
Correct.
and make it more available to people. Yeah.
Correct. Yeah, and I absolutely agree with the sentiment. And I think what's happening now is that the regulations are changing, mostly because software not just allows systems to run with more transparency and more openness because it's software. You can read the transaction details. But two, software is allowing regulators to access and regulate the markets much more frequently and easier, right? So it's now degraded that argument of protecting people, and now giving more and more people are retail investors are being allowed into the these financial instruments and markets. And one thing I see that really benefits with you and Carl is that you're doing exactly this, right? By bringing down the barrier to entry to take advantage of quantitative trading and quantitative finance and these quant funds, right? Like you're essentially allowing new generations of investors to kind of enter the market in this using sophisticated tools.
Right, right. I mean, I think that's, to me, it's very important to provide the access and create financial inclusion. I truly believe that, if you provide people with the information and the tools, they'll be able to make better decisions than, somebody else, because they're more vested, they have a vested interest. And
Absolutely.
yeah, I mean, that's the promise of the internet, right? Like, here's the information, it's there, use it. And in our industry, there is a lack of information. So we just, want to put the information out there, give it to you in a place where you can understand, where you can ask questions. It's a safe place for you to learn, for you to invest, for you to communicate and build a community around your interests, and around the community of quant hedge fund investing, right?
Yeah. Gunnar, thank you so much for your time and for coming on because, one of the things that, my takeaways from this is that, there are these social benefit companies that are blatantly obvious, right? Like, for every shoe you buy from us, we'll give two shoes to someone who doesn't have shoes. You can see the value chain. But there's also these soft social benefit companies like yourself, right, that use the power of technology to democratize and give access to those that previously wouldn't have access, and allows for more transparency and openness, and allows for more intelligent systems. I think it does better for everyone involved, right? So kudos for you and your team. I love to get more updates from Carl. We love this. Love to have a series of bring back guests in a series. So I'd love for you to come back in like 6 months to a year, give an update on how you guys have grown and the lessons you've learned, because I think what you're doing is really cool.
Thank you, man. Yeah, it would be fantastic to come back, obviously, and maybe next time we'll be in the same room,
Yeah, hopefully
right?
all this is
Yeah,
over.
hopefully.
Yeah,
Yes, yeah. Well, thank you
perfect.
so much, man. It's been a pleasure to be here. Thank you for the opportunity.
Absolutely. Thank you. Stick around for a few minutes. We'll do a quick debrief. But for everyone who stuck around, thanks. Check out Carl. And this has been Gunnar.
Thank you.